turning point hidden in plain sight. At the time, it didn't feel important. No alarms, no sharp moves, just a moment that blended into the background of daily market noise. And yet, that was the moment everything quietly changed. This story matters now because the most powerful turning points rarely arrive with drama. They arrive disguised as normality. When change hides inside routine, it reshapes outcomes long before anyone realizes a choice has been made. To understand why markets shifted direction without warning, we need to return to the turning point almost everyone overlooked. It began during a stretch of apparent balance. Markets weren't euphoric. They weren't fearful. Prices moved steadily. Volatility felt manageable. Commentators describe conditions as healthy, even boring. And boredom, in markets, is often mistaken for stability. The early reveal wasn't in prices, but in behavior. Buyers became more selective. Sellers appeared more quickly on strength. Rallies struggled to extend. Pullbacks no longer attracted immediate enthusiasm. Nothing was breaking, but nothing was accelerating either. Inside institutions, decision-making slowed. Committees asked more questions. Trades required stronger justification. Risk wasn't being avoided, but it was being rationed. The system was transitioning, not collapsing. The hidden turning point arrived when participants stopped assuming momentum would return on its own. For years, patience had been rewarded. Now, patience produced stagnation. Capital began rotating quietly, not chasing upside, but seeking certainty. No headline marked the shift. No single data point explained it. But behavior had changed, and behavior precedes price. The market was no longer leaning forward. It was standing still. That stillness was a signal. Because when a system stops advancing under favorable conditions, it reveals exhaustion rather than strength. The turning point wasn't loud. It was subtle. And by the time anyone tried to name it, the market had already moved on in a different direction. As the market lingered in that stillness, its internal dynamics continued to shift. Capital didn't flee. It repositioned. Long-held assumptions about momentum were quietly revised. Strategies that relied on continuation began underperforming, not through losses, but through inertia. The reveal deepened when familiar signals stopped working. Breakouts failed without explanation. Support levels held briefly, then gave way without urgency. Traders found themselves correct in thesis, but early in execution. Timing, once forgiving, became precise. The early conflict emerged as frustration replaced confidence. Participants waited for catalysts that never arrived. Good news was absorbed, not celebrated. Bad news was tolerated, not punished. The market existed in a narrow band where belief and doubt canceled each other out. Inside institutions, this ambiguity mattered. Risk models flagged reduced effectiveness. Opportunity cost replaced drawdown as the dominant concern. Capital that couldn't find direction became restless. Cash balances grew, not from fear, but from lack of conviction. Meanwhile, beneath the surface, leadership changed. Quietly, assets once considered peripheral began attracting steady interest, not excitement, commitment. Long-term flows shifted away from momentum and toward durability. The market's priorities were changing without announcement. What made the turning point dangerous was how ordinary it felt. No stress, no shock, just gradual disengagement from old habits. The system was adapting to a new environment while still wearing the appearance of the old one. By the time price finally responded, behavior had already realigned. The move didn't surprise those watching closely. It only surprised those waiting for a signal loud enough to demand attention. The turning point hidden in plain sight wasn't a moment of panic. It was a moment of pause. And pauses, when misunderstood, can be far more consequential than crashes. The pause eventually gave way to motion, but not in the direction most expected. When prices finally moved, they did so unevenly. Some assets broke down quickly. Others refused to follow. Correlations fractured. The market no longer spoke with one voice. The conflict intensified as participants realized the rules had changed. Strategies built for synchronized movement struggled. Hedging became unreliable. Diversification stopped behaving as advertised. What once felt like a unified system now felt fragmented and selective. Institutions reacted by reassessing exposure piece by piece. Broad assumptions were abandoned in favor of granular decisions. Capital flowed toward areas that had already been quietly strengthening during the pause. The turning point revealed itself not as reversal, but as redistribution. This was the most uncomfortable phase. There was no clear narrative to explain what was happening. Commentators argued over causes. Analysts disagreed publicly. The market didn't reward certainty, it punished it. Flexibility became the only edge. Those who had noticed the pause early adapted more easily. They had already adjusted expectations. They understood that the market wasn't broken. It had changed posture. Momentum had been replaced by discrimination. Participation required intention. As volatility picked up, it felt different from past cycles. Less explosive, more persistent. Moves didn't resolve quickly. Trends didn't announce themselves clearly. The system demanded patience without offering reassurance. The turning point, once invisible, was now undeniable. But it still wasn't dramatic. It was structural. And structural shifts don't announce themselves with fireworks. They reveal themselves through who survives confusion and who doesn't. The market was no longer asking for predictions. It was asking for adaptability. And the final lesson was about to emerge. The climax arrived not as a dramatic break, but as acceptance. The market stopped searching for the old rhythm and began operating within the new one. What once felt uncertain became familiar. What once felt temporary revealed itself as permanent. The resolution unfolded through alignment. Capital settled where behavior had already shifted. Strategies built for broad momentum gave way to selective conviction. Risk was no longer distributed evenly. It was chosen deliberately. The market didn't regain its old speed, but it gained clarity. In hindsight, the turning point had been generous. It offered time. Time to observe. Time to adjust. Time to step aside without penalty. But only to those willing to notice change before it demanded attention. Those waiting for confirmation arrived late. Modern relevance is unmistakable. Markets today still pivot quietly, still change direction without spectacle, still reward those who watch behavior instead of headlines. The biggest moves rarely begin with chaos. They begin with pause. The turning point hidden in plain sight was a failure of foresight. It was a test of awareness. Because the market always signals change. It just doesn't repeat itself loudly enough for those who aren't listening. Sometimes the smallest shift in perspective becomes the beginning of a new future. He